Hey guys, it's VK here. So I promised that I would be giving you a location today which I don't think you should be investing in, but there are literally dozens and dozens and dozens of agents and advisors and marketing companies, property companies that are getting literally hundreds of their clients into this location over the last actually 5, 6, 7 years. Okay, and over the last 5, 6, 7 years, these locations have done really poorly, but still to this day, there are so many agents and advisors getting their clients into this location. So I just thought I'd share that location with you, but more importantly, explain to you the reasons, as much as I can within 10 minutes, of why it's actually not a good location, right? And so you can kind of demystify all of these recommendations and do this yourself, okay? That's an important thing. And so if you like this video and if you got value and if you get value, just give it a like or love on Facebook, and that way you'll get more of these types of videos. And if you're watching on YouTube, just hit subscribe, and once again, you'll get more of these videos. So let's get into it. Instead of one location, I'm going to give you two locations, okay? So the first one is Leichhardt, okay? So Queensland, postcode is 4305. I'm looking at my computer right now because I'm going to be pulling up data and sharing it with you. So Leichhardt is an Ipswich in, which is obviously in Western Brisbane. Now, the reason why lots and lots of agents and advisors get their clients into Leichhardt is because it's positive cash flow, right? So let's have a look at the average yield, 6.31. Now, in this day and age where interest rates are, in the high twos or thereabouts, 6.5 or above 6% gross yield is easily positive cash flow. In fact, above 5% is basically neutral, if not positive cash flow. So it's a really easy story to say, okay? Look, I'm an agent, I'm an advisor, I'm going to get you, my client, into Leichhardt. You're going to be making $3,000 to $5,000 to $7,000 every single year. Positive cash flow, Bob's your uncle, happy days. Now let's look at why that's not a good idea. All right, and I'm not going to be talking about population growth, I'm not going to be talking about infrastructure, I'm not going to be talking about migration, the parks, the schools, because none of that matters when it comes to short-term growth. And short-term growth, in my book, is defined as within the first 5 years. Really, we want equity uplift, we want capital growth in the first 2 or 3 years, but at a stretch, let's say 5 years, just to make sure that this property is actually increasing in value and giving us positive cash flow. So I'm going to be telling you why and proving why that's not going to be the case. The door is just open, I'm going to close it, and I will be right back. Okay, so let's look at the data for Leichhardt. And I'm not going to be covering all the data, I don't have time for that, but just a few key data points. So the first one is the typical value. Now, the median value for Leichhardt has actually fallen since about 3 years ago, and I know agents that were getting their clients into this location 2014, 15, 16, completely missing the Sydney boom, the Melbourne boom, the Newcastle boom, the regional Victoria boom, the Tasmanian boom. Clients have suffered in this location. It has gone back by about $20,000, $30,000 in that time frame. All right. That in of itself is no reason to say it's a bad suburb, though. It might just be ready for a boom, but let's see if it is. More than 60% of all investment properties are rental properties, which means that what I've just said, agents are definitely getting their clients into this area. All right, and that's too much competition when it comes to rental demand, when it comes to getting a tenant and increasing rents. Days on market, and once again, just some top level metrics here. We won't go through everything in my system, but days on market have been gradually trending upwards. What that means is that it's taking longer and longer and longer to sell a house on average in a month in Leichhardt. So back in May 2018, it was taking about 50 to 60 days. And more recently, it's taking up to 125 days, which means it's taking 4 months to sell a house. Now that's a surefire way to lose money because demand is very soft. Okay, online search interest. So there's almost no one looking for property in Leichhardt, but importantly, the trend is not super hot. Okay, so in recent times it has been tracking a little bit higher, but it's on an absolute level very, very low. It's basically in the bottom fifth percentile of online search hits from real estate and domain compared to most other suburbs around Queensland. So from that perspective, demand quite soft. Percentage stock on market, so there is well over 2% of all properties in that suburb actually listed for sale. We want that to be under 1% so it constrains supply. When supply is low, prices have more chance of increasing because there's scarcity. There's no scarcity of supply in this suburb. What is the next thing that we can look at? Vendor discounting. So on average, vendors are having to discount up to about 6% to actually sell a house. We want that to be well under 5%, 5% at the worst. But the thing is that this isn't trending the right way, and it's really high. You know, for a property, they're having to massively discount consistently month after month to even get rid of it. So overall, I mean, this is just a few data points. We need to look at 30 to 35 really to get a sort of conviction or some robustness in our confidence of whether we should buy in the suburb or not. But just at these sort of key data points initially, the ones that we sort of just scan to see if it's worth a further look, I wouldn't be recommending this at all. Yes, you will get high gross yield, but the reality in Leichhardt, in Ipswich and Leichhardt, is that the socio-demographic is a little bit lower than what is normal. And so therefore you get a lot of tenant turnover, tenant issues, tenant damages, insurance premiums a little bit higher. And so that gross yield, even though it seems like it's really good, it gets brought down quite significantly when it comes to net yield, post-maintenance, post-vacancy, right? So not great in terms of that. Furthermore, there's lots of developable land supply in Leichhardt, and there's lots of new builds because land is so cheap, right? All things that say that supply is high and demand is low, the fundamentals of economics. The second suburb that I want to talk you through, hope I didn't go through that too fast. So I know there's plenty of buyers agents getting their investors into this area. There's one not called the B team, but very close to it. No disrespect to them, they're good in other ways. And that is Mango Hill. So Mango Hill is right next to Deception Bay, which is also an area where, close to Redcliffe, which is also an area where lots of agents are getting their clients in for probably about 5 years. You know, Brisbane's going to boom, Brisbane's going to boom, Brisbane's going to boom. Brisbane never booms, it hasn't boomed. Once again, the sell for Mango Hill, or actually let's not look at Mango Hill, let's look at Deception Bay, because it's one that's actually more popular. The sell for Deception Bay is that it's next to the ocean. Now in Melbourne and Sydney, if you're next to the ocean, it is a very expensive suburb. And so the logic goes, dear client, that we will get you a house within 20 to 30 kilometers and you know, the Brisbane CBD, great lifestyle next to the beach, next to the ocean, you know, quiet, peaceful area with lots of activity happening in terms of commercial and residential. You know, population is growing. Let's get you into that area, and that's a really solid property investment. I'm talking about Deception Bay. Now that is completely wrong. The easy way to sell that is what I've just said, and also the fact that it's neutral to positive cash flow. You can see how I can convince you to buy in Leichhardt, I can convince you to buy in Deception Bay. But the reality, once again, if we look at that, is the percentage renters are almost 45%, above 40%, tad on the high side. Online search interest is also very low. It's in the lowest 20% of online interest amongst Queensland suburbs. The gross rental yield, like I said, is pretty good, but it's been pretty flat. There's not been much growth in rents. Stock on market is once again well above 1.5%, which means that there is not much scarcity of listings. When there's lots of listings, it tends to suggest, as a percentage of total properties on the market, it tends to suggest that supply is high. Okay, and so this isn't really shaping that well for Deception Bay. And yeah, those are the key reasons. Some other points are relatively good, but the main thing I wanted to share, right, is that even in Deception Bay, it's right next to North Lakes, it's right next to Mango Hill, lots of residential development occurring, lots of developable land supply, and what that means is that prices won't grow. And so let's see what prices have done for Deception Bay over the last few years, and they have basically been flat. Okay, so once again, if you were a client of a mainstream agent, buyer's agent, etc., you would have bought in this location 5 years ago, 4 years ago, 3 years ago, and yes, it's a cash flow neutral property, but it hasn't gone up in value. So what does it actually achieve for you? Meanwhile, you could have bought in Mildura, like I shared on one of these videos before. Meanwhile, you could have bought in Bendigo, Ballarat. Meanwhile, you could have bought in Western Adelaide. Meanwhile, you could have bought in Hobart and made $100,000 to $200,000, sometimes $250,000 of equity gain off a $400,000 to $500,000 house, depending on the region, in the same time frame. Okay, so the key takeaway message from this video is do your homework, do your homework, do your homework. The system to understand which suburbs are going to do well from a cash flow and capital growth perspective is possible to learn. You don't need to spend your full-time career on it. You can understand how to do this within 5 to 10 hours worth of learning, all right? Not learning at a classroom, on a seminar, or some sort of yuck hotel sort of seminar where they sell you stuff at the back of the room, but deep data learning, adding, subtracting, division. You don't need to be a rocket scientist. You can learn how to pick the right suburbs yourself in no time. Okay, but if you do want to go to a buyer's agent, please, please, please don't just go for the high level recommendations. Don't just go for the positive cash flow story. Don't just go for the population growth. Don't just go for the activity or the income story. Don't just go for the fact that it's close to an infrastructure or a new infrastructure project, or it's close to an ocean. You need to look at data, because data, true data, statistics, is the only thing that can predict or forecast or anticipate short-term price movement, sub 5 years, ideally sub 3 years. Long-term, 20 years from now, everything does well, all right? But we want to buy high cash flow property, positive cash flow property that gives you an income from day one. And we want to buy positive cash flow property that also grows in value, capital growth, in the first 1, 2, 3, 4, 5 years, so that we can take the equity out and buy more cash flow property, right? I'm not against positive cash flow. We want more of that. The only way we can get more of that is through equity growth as well, okay, in a passive strategy. So that's what we want. If we put in a twist, a kicker, and development opportunity, reno opportunity, buying under market, all that stuff is also good to learn, and the stuff that I teach as well. So look, if this is resonating, if this is meaningful to you, if this doesn't just seem like marketing, then potentially there's something for you to learn. There's potentially something for you to take and really accelerate your property investing, because what is possible is for you to generate a sizable passive income in, for most people, 10 to 15 years time, and actually give yourself some choice so that you can retire or at least reduce your hours and get out of the rat race. So if that is something that you're interested in, look, there's plenty of buyer's agents. I don't need to market them. Some very good ones that don't do the marketing that I've just described, that actually focus on the data. But if you want to do it yourself and you want to be self-sustaining and you want to build a portfolio of 2, 3, 4, 5, 6, 7 properties and don't want to spend 10 to 15K every single time on buyer's agents, and at the same time, you don't want to waste your weekends at inspections, and you don't want to waste hours and hours and hours of research on realestate.com and get nowhere, then feel free to drop me a message. You can DM me, but I'll also leave a link right below a case study where you can find out more. And if you think we're on the same frequency, if we vibe, then you can get in touch and I can see if I can help you, and you can see if I can help you as well, right? And equally, if I'm not a good fit, or if this doesn't vibe with you, I still highly recommend that you learn the data, right? Learn the data, learn the data, learn the data, because the data will make you rich, not marketing, not webinars, not seminars, not anything else. It's the data. So really learn that and get your time back. All right, well, that's basically all I have to say. My name's PK, and once again, really appreciate it if you get some love back and like or love this video. If you watch it on Facebook and you actually see more of them, that's how the algorithm works. And if you're watching this on YouTube, just hit subscribe. All right, guys, well, I'll leave the link below, and speak soon. Catch ya, bye.